Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Chris Haddon. Chris is the co-founder of Hard Money Bankers and handles investors' relations, as well as oversees the loan portfolio. Chris designed the loan servicing and accounting operations for HMB, which allows the company to manage a $50 million loan portfolio in a very efficient manner with minimal staff and overhead. Chris is also an avid growth marketer, and his efforts over the years have allowed HMB to be recognized as one of the dominant private lending companies in the Mid-Atlantic region. Chris and his business partner, Jason Balin, co-founded hardmoneymastermind.com, a premier membership site for private lenders across the U.S. and Canada. So, Chris, welcome to The Wealth Flow. I'm looking forward to this.
Glad to be here. Thanks for having me, Keith.
Yeah, I typically will start with sort of your background, where you grew up and what actually led you to real estate.
Yeah, sure thing. So I'm from Rockville, Maryland. My business partner and I both are. It's a suburb of DC.
Okay.
Yeah, and he and I, after college, went to college different places, ended up back around our hometown. This was like, early 2000s, 2003, right around there. And looking to get into business, right? Looking to figure out post-college, where we were going to fit in the business world. And he was doing some real estate. I got in the mortgage world. I worked for a large commercial bank, and I had a good 5-year run. Learned mortgage banking, commercial and residential real estate, credit, marketing, finance, just like it was a really good business 101. I saw that niche as being, I knew I wasn't going to be there forever, but it was a great place to get started from like maybe 23 to 28. And during that time, Jason and I started buying some residential real estate around DC area, also around Philly, and just kind of figuring out the game of how to flip a property, how to own and manage a rental, getting our feet wet. Definitely made some mistakes, did a wholesale or two. And for a few of these deals, we borrowed private money, also called hard money lending. It's kind of transitioned over the years from hard money to private money, which I like that. I mean, I like the change in that terminology. The only problem being our company's name is Hard Money Bankers.
Right.
Anyway, at least you know exactly what we do when you see our company's name. But anyway, during that time, we borrowed from a private lender, a guy out of Texas, doing flips and stuff like that. And we made some money on the deals, but it was a lot of work, right? And we noticed that this lender didn't really have to do much of anything, and he made around the same money, maybe a little less. But, the work in from money out equation, his was a lot better than ours on those flips. Yeah. And we also learned that we didn't really love construction, design, like very specific, like property focused stuff that wasn't with a lending background and everything else. That wasn't what we were best at. So we decided to start our own lending company. And that was probably started mid 2007. So the only problem being the whole real estate and financial world had just crashed.
Yeah, exactly.
for the people in the audience who were in business around that time, with whether you were or weren't, the Great Recession was it was pretty dark. And so I was transitioning out of the mortgage industry and into running our own shop during a time where like the sentiment around investment real estate and real estate in general, because of subprime mess and all that stuff, the sentiment was really, really bad. And here we come, we're 27, 28, and we're like, hey, you should invest capital in private loans on investment real estate. Sounds great, right? So obviously it was a very difficult time to start, but it was also a great time to start because it was at the bottom. The market was at the absolute bottom. And it's frankly been going up ever since with a few hiccups here and there. But it's been a great run. And it's interesting because when we started, like I said, we were in our 20s. A lot of our competitors were, in their 50s. Yeah, and we were like the next generation kind of. And so throughout these 17 years, coming right up on 17 years now, we've become the older guys. We were the next generation, and we have recently transitioned to the older guys. And then we can get into the institutional capital and all that stuff creeping into our market. But all in all, it's been a great run. HMB is a really good business. We have 50 million deployed in the portfolio around the Mid-Atlantic region, 6 states around the Mid-Atlantic. We're a team of 10, and it's just a tight shop, an efficient, profitable shop.
Yeah. Let's tell me a little bit about, so when you were doing mortgage lending with various banks, were you doing primarily residential or did you do commercial as well?
It was mostly residential. Okay. I was at SunTrust Bank, which is now merged with another one. It's now Truist. It was SunTrust Bank, and I was doing mainly residential, but I got to overlap into commercial loans. So I learned how to underwrite income and stuff like that and commercial due diligence. And at HMB, we do both resi and commercial. So it was good to have that banking background, that experience. And yeah, like I said, it was just a good place to start.
Yeah. And so when you started in 07, and I guess how many houses did you guys flip when you were doing that?
During that period, we probably did 5 flips, 5 wholesales around there. We owned a couple rentals. And later on, we did start buying real estate again. And we can go through that transition as well. But a handful, call it 10.
Yeah.
Between those kinds of deals. Yeah.
Yeah. But through that experience, you were able to see that, gosh, I'm putting in all this work and, the lender is making almost as much, if not, if not the same on certain deals.
Yeah, and it just has to do with your skill set. We're just better at lending. Like our clients who we lend to, like they're great at flips. They're really good at real estate, design, everything else, running construction crews. It's just not our strong suit. We're better at the lending part of it, finance, marketing, all the stuff that goes into this operation.
Yeah, for sure. And then you started in 07, so tell me a little bit about the start. You mentioned there's struggles, right, with real estate just being, prices coming down, things not moving near as quick, all that good stuff. But how did you start? Did you start with a single loan and then it just kind of manifest from there, or what?
Okay. When everything was crashing, there was a huge foreclosure wave, right? Like foreclosures were happening left and right because of these over-leveraged subprime loans and everything else. And then prices started coming down. And that's around the time we were starting to look at lending, and you need capital to lend. And there wasn't any around. There was no institutional money in that space. Banks weren't doing credit lines. Some of the lenders who were in business during the boom, during like 2005 and 6, when everything was at the top, a lot of them had taken big hits, lost money. A lot of people got, over aggressive and too high on leverage and, the same old story, right? So just having some funds to lend, which we had from a couple investors that we knew, and literally just a few people that we knew, like friends and family type stuff. We didn't come in with a bunch of our own funds, or like I couldn't hit up my dad and be like, give me $1 million, like that. None of that was part of the equation. But we had a few business contacts that were willing to put up some money for some deals. And we were incredibly conservative on the deals that we did. We were just terrified, right? To lose somebody's money. And that's how it started. Yeah, it was December of 2007. We closed our first deal, and we were pretty much all in right then. Within a couple months, I quit the job at SunTrust. Jason had already quit the mortgage company where he was, and we were all in. We a couple months later, we were on a plane out to Vegas going to a hard money lending conference. And there's not many. There's more of them now in the industry, but back then there's very little content of any kind about this niche of lending. So we were on a plane out to Vegas and just talking on the plane there and back and just figuring out how we were going to piece this thing together. We were renting space in the back of a title company for $500. And that was our first office. And I remember just the transition of going from a banking job where we would dress like business casual or sometimes suits and stuff when you have a meeting to, I can go to the office in jeans. Which is completely normal now. But back then it was like, whoa, this is weird. Like I felt like there's no safety net. There's like, you have to close deals to pay your bills. Right. So starting up, I mean, it was very challenging. It was a difficult time. But we closed probably 20 deals our first year. And then after that, it was just double for a bunch of years. And at some point, you kind of level out and, you hit capacity in a given market. And we found other ways to expand geographically safely after that. But yeah, it was a ride at the beginning. And a lot of what we were focused on was just being very, very intent on not screwing it up. Just not losing people's money or doing something we shouldn't do. Like there's all, I mean, as a 20-year-old, 30-year-old business owner, there's just a lot of stuff you don't know
for sure
at that point in the game.
Well, tell me a little bit about that. Like as far as, how did you structure the initial ones? You mentioned being very conservative. What type of, there's always, it seems in the peak of the market, it gets, really crazy where, you're able to borrow, construction costs, which I know there's still even some of that, but oftentimes you're borrowing up to X amount, and it doesn't seem like oftentimes the investor has that much skin in the game on some of these deals. Again, at the peak of the market, I know a lot of it's dialed back, even in this most recent little bump in the market. But tell me a little bit about how you started that out. What kind of guidelines were you using? What were some things that were allowing you to be conservative on these?
Yeah, sure. And you did start to touch on one of the main ones, which is skin in the game. So we have our real estate investor clients, our borrowers, bring significantly more cash than most lenders do. And we lose a lot of deals because of that, right? So if we're just talking about fix and flip, which is a good portion of our portfolio, it's not the whole thing. We do commercial bridge and stuff like that, but talking about fix and flip because it's probably most familiar to the audience. On average, we'll have clients bring, probably 30-40% of our loan amount in cash, which is conservative, right? Which is low leverage. There's people out there doing way higher leverage, and it's just not our game. And the reason why it's not our game is because we've seen too much. We've been around. We've had the defaults. We've had the foreclosures. We know what the numbers look like on a bad deal. And frankly, like the amount of leverage that a lot of lenders are doing these days, especially the institutional backed ones, is just setting up to lose money. Like maybe it hasn't happened yet. Maybe they have losses. Maybe they're just unrealized at this point. Like who knows? But having gone through so many defaults and stuff, we know what it looks like. We know what it looks like when a deal goes sideways and construction is incomplete. And that's always, like we say in the mastermind group, nobody has an ARV problem. We don't have an after repair value problem. Once a property is done, we're in a fine spot. We have a $300K loan. The property is on the market for $475.
Yeah.
Almost no risk, right? But before that property is done, we do have risk. We don't have an ARV problem. We have an as-is value problem, right? And so if you're talking about a lot of so we say that we go up to 80% of the purchase price and 100% of the construction costs, which means that a real estate investor borrower will be bringing 20% down payment plus closing costs. So call it around 30%. And when some lenders are going higher and higher and higher, like if you're doing 90% of a acquisition price and they don't do the construction work, you have a problem. You have a problem because, people can get sideways. Sometimes they get over their head in doing a few deals at the same time. We have a situation like this that we're managing through currently. We have one loan with a client. This is in New Jersey, and we've lent to him probably 5 times, always performed, right? And so in this particular case, we did a loan, a fix and flip deal, and then he had 4 others that we did not lend on. But he went sideways on some of these other deals we weren't involved with, and it basically brought down the whole operation. He's short on cash. He can't complete any of these jobs. Yeah. So the properties are going to have to be sold as is. So what does that exit look like? Right? And so that's kind of why we're so conservative. People think, like, especially in the mastermind group, they give us a hard time for like, why'd you go so low on this deal? Like, how do you get away with that? Like, why do your clients agree to it? That sort of stuff. But again, it's because we've seen it. We've seen too much. We've seen too much in these 17 years. So we do leave a lot of money on the table by being so conservative, but it's just how we got to run it.
And is that why you're staying kind of in a specific geographic area? You just favor that area as well? And maybe that's kind of hedging your risk a little bit as well, just being familiar with those markets?
100%. You have to know what you're lending on. So we started in DC Metro because that's where we're from. And that also kind of overlaps into Baltimore. Like DC and Baltimore are only maybe like an hour away. Yeah. We started in DC and Baltimore because that's where we're located. That's where we know. We're on MLS. That's another thing that, we kind of jab the industry a little bit about being so reliant on appraisals, because an appraiser has no economic interest in this deal, right? They're doing their best. They're giving you the best opinion of value that they can, but they're not on the hook for anything. So if you're relying on an appraisal to say this property is worth $500K, there's inherent risk in that. It should be the lender, the person who has the risk in the deal, determining the value. And granted, you can get a third-party opinion of value to have in your file in addition, but any private lender should know and feel comfortable with the value of the property by being on MLS, LoopNet, CoStar, doing your own due diligence, knowing how to underwrite income, stuff like that, so that you know what the property is worth, right?
Yeah, for sure.
And the industry has gotten away from that a lot in recent years because of the influx of institutional money. But yeah.
And when you say you're on MLS, you're basically, you're running your own comps. You're able to say, I know even like throughout this recent kind of transition where rates went up, we were in the middle of a flip at that point. And, you had to be very careful about where you were pulling your comps from. And normally I would say 6 months, 12 months. But, when you start looking at 12 months, 6 of those past 12 months in this particular point in time when I was in the middle of it were when rates were super low and they went up substantially. And so no longer, sure, you could think that you might be able to sell it for that amount, but just that change in rate is pushing people, pushing the values, down on the exit. So.
Yeah, no, my business partner, Jason, and also our business partners in Philly and New Jersey, they have MLS up on their screen all day long.
Yeah.
Comping properties as is, ARV is just, I don't do that day to day so much because I handle the investor relations side, kind of like CFO sort of role. I don't use that title, but investor relations, I manage our accountants, I manage our defaults and the attorneys who handle them. So I'm not doing the MLS all day long, but 3 of my business partners absolutely are.
Okay.
Yeah.
And then what about as far as structuring it? If you are paying for the repairs, for the audience, how do you protect the investor's capital when you're looking at these? Do you do like video walkthroughs? Are you close enough that you got somebody with boots on the ground? What are they doing to assure that the construction has been completed in these various phases?
Yeah, we have inspectors and do draws. So here in DC Metro, we have a full-time inspector, And he's basically 2 days a week in DC area and 2 days a week in Baltimore area doing draw inspections. And same in Philly and New Jersey, although we have a few more people instead of a full-time guy. That's a huge part of it. I mean, being a construction lender, you have to be tight on your draws and you have to be quick. You have to be quick. Yeah. When we were getting started, we talked to this old school hard money lender, Baltimore guy. He's passed away now, but he told us right from the beginning, just make sure you check these 2 boxes. A lot of other stuff you could do wrong if you want, but you always have to close on time and you have to give draws quickly.
Yeah,
and you can mess up a lot of other stuff, but if you do those 2 things well, then you're going to have a lot of happy clients. And yeah, that's always been part of the game plan.
Yeah, it makes sense. For somebody who is borrowing, it's half the battle is just getting through that draw process. And then, when you submitted it, however, sitting and waiting, so you could pay your contractors is no good.
No. And that's exactly why, because you have to pay your contractors. You have to keep the job moving. And you even risk losing, like contractors are, a little flighty. Like if they're not getting paid, they'll go hop to another job.
Exactly.
So yeah, it shouldn't be that. It shouldn't be that kind of battle. Like that's bank stuff. Like if a bank is jerking you around like that, that's to be expected. A private lender shouldn't be.
Yeah, for sure. Well, and so how, if somebody was interested in investing in these, are they putting in a specific amount and going to all to one deal, or how? Tell us a little bit about the landscape from an investor's perspective if they get involved with one of your deals.
Yeah, sure. So we have had the same investors around now for 10, 15 years. Like we were actively raising capital in the beginning, of course. We needed to quickly. I needed to quickly, which was a stressful time. But we hooked up with some great investors, basically business associates, and then it kind of grew out into friends and family, and over time, our own funds too. So everyone's been around for many, many years, and we're close with our few dozen investors, which is basically all it takes. So we don't actively raise capital anymore.
Okay.
Frankly, we have a lot on the sideline, and investors are always kind of bugging me to deploy for them. So to answer the other part of the question, if I could snap my fingers and be a fund, like a Reg D type of fund, I might do that. But we didn't have that option in 2007 and 8 because we needed the transparency of investors knowing which deals they were getting into. They wanted to in order to give us money, to put money into these deals, they wanted to know exactly what they were getting into. So we went with the co-lending model, direct placement. It has a few different names for that. So we'll have anywhere from, maybe typically 1 to 3 investors per loan.
Okay.
And so they know exactly what they're getting into. Some people like to see the deals before funding. Some don't. Some are more passive and they don't have an interest in underwriting up front. It's all managed very well by a loan servicing software. So everyone gets a monthly statement. They see which deals they're in and some, pertinent data about each loan. We pay electronically and we pay weekly, which is interesting because we have 220, 230 loans outstanding. So every day there's a loan that funds, a loan that pays off, monthly payments coming in. Like monthly payments, like we pull them electronically, and it would be nice if they all came in on the first, but the reality is that they don't. And they come in every day of the month. So every Tuesday, our controller sends me a report of here's everything going out, right? And so that is a bunch of investors getting paid, us getting paid servicing fee. Anything that's come in is going to be flushed out. And the system makes it very easy to do. And the cool part about that is prior to this system, we were cutting checks and we were sending them monthly, which is okay. There's nothing wrong with that. But the higher frequency of touching our investors, of being in their inbox electronically every week, paying them money, it starts raising capital for you.
Right.
Right?
Yeah, no, it makes sense.
Instead of a check coming in the mail, there's no easy way to reach out to me when that happens. If something hits your email inbox, you can easily reply and be like, hey, Chris, you won another $1 million. So it's a really, really cool machine. So our investors have been around for a long time. They're happy with our deals, really good relationship. Over time, we're putting more and more of our own funds into the deals, which, is really where you want to be. And that's another thing that a lot of the industry misses, is that they don't realize that this model was created to lend your own money for a good rate of return, not to package and securitize and sell it and Wall Street and blah, blah, blah. It's to earn money with your money. That's how this business started. And a quick funny story about that. One time when we were early on, we're probably a few years in, and we had started doing well at this point. Jason and I were taking home some good money. And at the beginning of the year, so we were doing 1099s for our investors, which are due to go out by the end of January. And one of our larger capital investors made about 20 grand more than we made. His couple $1,000,000 in our deals had more earning power than our entire year of work.
Wow. Yeah.
Right? And so we saw that. We're like, oh man, we really got to get diligent about investing in our own lender accounts. And we have ever since. We've been very diligent about that. It's a big part of the future. It's a big part of the next generation, potentially. We'll see. But lending your own money is what it's about. In essence, the way it breaks down is just to use like very round numbers and metrics, is that you end up with about half of it when you're using investor capital. You make about half the profit and about half goes to the capital investor, which is still a good model. There's nothing wrong with that. It's a very profitable model just like that. But if you're the investor, then you get 100% of it.
Yeah.
And that's pretty cool. So that's a big part of the focus, has been for a long time, and will continue to be, investing our own funds in our own deals.
Yeah, it makes sense. What are some things, obviously you guys have the mastermind. What are some maybe misconceptions or things that people don't realize about private lending, things that folks need to know? I guess kind of give us, kind of the overview. If there's somebody that says, hey, Chris, this is something I'm thinking about doing, give them an overview of how exactly that works, and maybe what are some of the misconceptions?
Yeah, no, that's an important question, because that's basically why we started the mastermind, is because we created the group that we wanted to join, because there wasn't one in the industry. There's some content around private lending, but not a lot compared to, like, say, real estate investing. There is a ton of content about that. Conferences, books, groups, like an absolute ton. Private lending, very little. There's a couple industry conferences. There's like, we run like one of two podcasts. I mean, there's podcasts on everything, and there's barely even one on this topic. Yeah. So backing up a little bit, we got a call from a lender in Richmond, Virginia, which is about 2 hours south of DC, not in our market, because he had been following our stuff. This is probably 8-9 years ago, something like that. He had been following our stuff on social. He reached out and was like, I really like the way you guys run your lending company. Is there any way I can throw you some money and come like learn from you for a day or two? And we're like, it's an unusual request. Like, when you're not in that business, you don't normally get that ask. Yeah. But we're like, sure. His name's Nick Capitanis. He's a great guy. He's a friend to this day. We're like, sure, there's a number for that. Come on up. And so that's kind of how we started offering consulting to private lenders who want to deploy money, either their own or investor capital, and need to do it safely and responsibly and everything else. And there aren't many resources for these people to go to learn how to do it right. And so we created the mastermind group. There's an online mastermind, and then also there became like an inner circle offline meeting. Like, we have our next meeting in Tampa in early November. So we're going down there soon. And there's about 30 lenders coming. They've been with us for a handful of years, and they needed a resource for how are we determining values of properties, right? What makes a good borrower candidate versus maybe not so much? How do we, package deals prior to closing so that we're checking all the important boxes, insurance and everything else, attorney prep, loan docs, title review, like all the important stuff that goes into a lender's job that could get missed, could get skipped, right? In like a risky kind of way. And then how do you manage the whole operation on the back end with software, with people? Like, what does that all look like? Raising capital, the different structures for that. So in essence, we created a group, the exact one that we wanted to join. So it's been a great ride. So we've had the inner circle part of it for about 3 years now, 2.5, 3 years. and seeing the trajectory of the lenders in the group who come in with like 5 or 7 million outstanding, and now they have 15 or 20. Like that's been really, really cool to see. And, some people in the group were able to, quit their full-time W-2s and go all into lending if that's what they want to do. And that has happened a couple times. And so it's been a really, really cool ride. Yeah. I don't know if that's the misconception part of the question, I think is I kind of answered with, there's a bunch of stuff that lenders need to know to do this job right that they're probably missing. That's the misconception. The misconception is, how do you do this safely? Okay, well, let's talk about that.
Yeah.
Yeah.
And what are some of the mistakes that people will typically make on this? Like maybe the most common, if somebody decides, hey, I'm going to do some private lending, I see the returns could be good. What are some of the most common mistakes that you see out there?
Most common mistakes, number one for sure, is too high leverage. Having an investor that you ran into at a meetup group and financing 100% of their flip is great for the real estate investor, and it brings down their level of risk, but it puts the risk on the lender, right? And if you think about a first mortgage lender in any real estate deal is supposed to be taking the least amount of risk.
Yeah.
First mortgage lender has the lowest return and the lowest amount of risk. That's how it's supposed to be. And so when some people are just going willy-nilly and do a deal and being like taking all the risk, 100% financing, like very little, skin in the game from the real estate investor actually doing the job, they're changing that risk dynamic, and that's a mistake. So that's a very common one. Not knowing how to paper a file related to the borrower either. Credit report, financial stuff like that. Just normal. Like we're not going crazy with it with tax returns, and like we're not doing it like a bank. We want to make their life easy. That's part of it.
Yeah.
That's part of being a lender with good service. But at the same time, we have to be protected. Do we need to do background checks? That's an ongoing question mark. So that's some of the common mistakes, is like not understanding the value of the collateral and going too high on leverage, and then also not knowing how to paper a file in terms of the borrower either.
Yeah. Okay. Interesting. And when did you start getting into the commercial side of lending?
So I don't remember exactly. It was early on where we had enough of a commercial background to feel comfortable with what we were doing. And again, we were just doing it conservative. Like we probably average 50% loan to cost on commercial stuff. We just did one in DC for 1.5 million, and the as is value is about 6 million. So it's like, okay, hard to screw that one up, right?
Right.
And it's interesting because most resi lenders don't do commercial at all. They don't understand it, don't want to mess with it. They don't want to get into the due diligence, like different types of appraisals and underwriting income and environmentals. A lot of resi lenders don't have that kind of background, and we were comfortable with it, so having the flexibility to do both. Like we don't do all that many units of commercial, but the loan amounts are big, right? And having that ability has been a really important part of our business.
Yeah. Okay. And what about the software? What's kind of separates your software? It's based on the introduction, that was a big piece of your design with the loan servicing. And tell us a little bit about what makes that different and why it makes it so efficient.
Yeah. So most lenders are going to start on QuickBooks and spreadsheets, as we did. And that's normal. When you have a few loans outstanding, it's just cost effective to do it that way, right? So you're just tracking your stuff on a spreadsheet, manually cutting checks from QuickBooks, and that's okay up to a point. Once you get 10 or 15 loans outstanding at any given time and beyond, you're going to want one of the industry software. And so like there's two main ones. There's the Mortgage Office, which we use, and Mortgage Automator, which we're friends with too. The Automator guys were at our last Inner Circle meeting in Dallas in the spring. In our room, like in the Inner Circle there, it's probably more and more Mortgage Automator users than TMO, the Mortgage Office. But either way, you need a professional solution to track these loans properly, to pay your investors electronically, to have proper reporting, all that stuff. Once you get past 10 or 15, like you have to cough up the money, get proper software, and get up and running on it. And it can do great things for the business. Like I was mentioning before, just the frequency of payments and proper reporting. And like, it's huge. It's definitely huge to have the right software in place.
Yeah. Okay. And I guess, tell me a little bit about if a loan goes bad. Obviously, having the percentages, but not every one of them is going to work, right? You're going to have some that, as you mentioned, the guy runs out of money, the guy, whatever. What's the process at that point? If a loan goes bad, are you going to try to work it out with them, or you going to take it back and try to sell it as is? What are the exit strategies on one that maybe doesn't go as planned?
Sure. So the first step is always to work with them and try to find a solution. In the event of I ran out of money and this property's 80% done, but not 100% done. Like that sort of situation's common. And 9 times out of 10, the right answer is to sell as is. If we can work with the borrower and be like, we're not going to default you. We won't even change the interest rate to the default rate or send a letter or anything. Just get this thing on the market and unload it. That's 9 times out of 10. That is the answer. The difficult part is sometimes when people get into a default situation, they hide. They don't return the calls. They don't allow us to work it out with them. They just kind of hide. And in those situations, we don't have any choice but to have the attorney send a letter and start foreclosure process. And also it's challenging because some of our clients will take our advice in like a situation like that. Like your only move if you're going sideways, stop the bleeding, just sell this thing. Don't rack up more interest and late fees and attorney's fees and stuff like that. A lot of times they don't want to listen to us. They think that we're not on the same team, but we are. We're on the same, like we're both invested in this deal. We both have an interest in seeing a decent exit. So, I mean, I would, advise real estate investors for private lenders who actually know what's going on, not an institution, but guys like us, independent local shops, we know this business too. We're in this business too. So work with us to find a solution. And, if that doesn't happen, then obviously we have to start foreclosure and everything else. Most of the states that we're in are judicial foreclosure states, so they take quite a while. And hopefully we never it's rare that we actually get to an auction sale. Normally a real estate investor is going to figure out an exit during that 6 or 12 months, to whatever it takes, depending on the state. They'll typically figure a way out, and we'll be, encouraging them along the way to do so.
Right.
And then, maybe it'll get to auction sale. Like currently we own one or two properties we own out of, 230 loans outstanding on average. So it's rare that we take back a property. It's less than 1 a year.
Okay.
Yeah. And we don't want to. We don't want to own properties. Like the numbers don't look good when you get to a foreclosure. I know that some investors think, and you probably heard a real estate investor say this, like, oh, they just want to take the property. It's like, no, we don't.
Right.
Trust me. I run a group full of private lenders. None of us want to take back the property. It's nothing but a hassle and a potential money loser even.
Right.
So,
for sure.
Yeah. So word to the industry out there, we don't want the property. Trust me.
Right. And tell us a little bit about the, you mentioned earlier about institutions kind of in this, in this space. What are you seeing out there? What's kind of the landscape look like? What do you foresee? Obviously none of us have a crystal ball, but, moving forward, I mean, I've heard, institutions are starting to get out of single family, now, when they were, kind of going straight to it. But, and then I've heard, hear mixed things on that. So what are you seeing out there?
This is going to be a fun one.
Okay.
Institutional money started coming into our space around, call it 2015, 16, something like that. Literally in our office, guys from New York being like, can we invest funds in your deals? And we had never heard that before. And raising capital is always a big part of the job. Raising capital from high net worth individuals, is investor relations, a lot of work. And these guys come in and they want to just give us money, and it's a little cheaper. The money's a little cheaper too. We're like, we should look into this. So we did look into it. a couple times. And here's the thing I didn't like about the mortgage industry, the conventional mortgage industry that I was in at the beginning of my career, is I didn't like the profit margins and I didn't like the lack of control.
Yeah.
So that's what institutional money brings. So that's what it looked like when we looked at taking on this capital, in essence, like selling loans to them. They're like, okay, here's your underwriting matrix, right? Like bank style. Here's your underwriting matrix. Here's your LTVs. Here's your like price add-ons. Here's what the credit needs to be. Here's the process. You got to submit through this thing. And it just all felt very, very bank-like and very opposite of how we wanted to run things. It felt exactly like what we just got away from in the conventional industry. It's like now the control's up to you and you make the underwriting decisions and you're controlling the flow. Like this just all felt wrong. And it was a little bit cheaper, so you have to consider it, right? And what happened was we never went with that source of capital, but the majority of the industry did. And they took on institutional money. Some lenders are in business only because of institutional money. They weren't going to raise capital on their own. They weren't going to be in this industry. They only got into it because Wall Street's offering them a bunch of money at, 7-8%, whatever it might be. And the volume of lending went up incredibly, and people started cutting prices and competing on volume. Like what was normally, look, when we started in 2008, the normal pricing for this kind of loan was 15% and 5 points is what it was in 2008. And that was a little high. And it came down to, in essence, where we are now is 3 points and 12.99. And we came down to that gradually over time and stayed there. And we're priced a little high in the industry, but not that much for a while there, especially with low rates. And it went down to like 9 and 1. And we have a local competitor, sort of competitor in DC. And we were friends with the founders. And they started doing loans with institutional money basically for free. And they were putting out tons of volume. No, they would literally say like, we'll do it 8% and no points, like kind of thing. Like, what are you doing this for? And they're putting out tens of millions a month. So what does that look like at the end of the day? In terms of bottom line. So if you're making more money than we are, then you're winning the game. Like, I'm not going to argue with that. So like Alex Hormozy says, like business is a game where score is kept, and that score is money. And if you want to take on institutional money, put out hundreds of millions a year, have do it really cheap, have a big staff and overhead and everything else, and your bottom line is better, by all means do it. But I'm not sure that's the case because that's taking private lending and turning it into the conventional mortgage industry. That's literally what's happening and has been happening. And I would love to see the P&L of some of these companies. Some of these companies with the institutional money and the cheap terms and everything else, like I would love to see their P&L. They're not going to show me their P&L, unfortunately.
Right.
But our mastermind group in the way we run our company is kind of like let's keep the model the way we want it, the way it's been. And so then you have this debate between modernizing the industry in that way that all the institutional guys are modernizing. They use that term, they use some other terminology of like, that's the idea basically, but is it making it better? Is modernizing improving? Not necessarily. It's just kind of changing the face of it. And so it's been really, really interesting to watch. And I don't fault anybody for running the business in the best way they see fit. We have to compete against that. And sometimes we become like a plan B sort of lender. Like if you can get 10%, it's not that cheap anymore with rates higher, but like it's a lot more about leverage because they do extremely high leverage. Like if you can get, $750K on a given piece of property and HMB is only offering you $650, go for it, right? Go for it if that's what you want. And then in the situations where that doesn't pan out, they come to us kind of as a plan B. And that's all right. That's all right.
It is part of the plan B scenario. It's not necessarily, I assume they're paying just a little bit more. Maybe the leverage isn't as good, but what is causing them to go away from that? Is it
Away
the
from
underwriting?
planning.
Yeah, underwriting requirements, or
It varies. Oftentimes it's time frame, because if you're working with an institutional lender that's going to take 30 days or 3 weeks or something like that, and they have to get appraisals, and
yeah,
oftentimes it's just time frame. Like if you have to close by the end of the month, and there's like a couple days left in the month, we can close it. So we get those deals all the time. And sometimes it's stuff that falls outside of that underwriting matrix I was talking about. Stuff that falls outside of that. Maybe it's an auction buy, or maybe definitely commercial. There's no commercial going on in there. Other stuff like that. Maybe they can't get access to the interior, right? And so they're like, oh, we can't do it if we can't get access to the interior. Maybe it's still tenant occupied, or like whatever the situation may be. Little things that fall outside the matrix end up with our clients going to plan B, which is us.
okay. And if somebody is interested in getting, started in, private lending, interested in joining the mastermind, what are, from a standpoint of funds, how much does somebody need to really, do you feel to really get into this space? Obviously they have the ability to raise some capital, but let's say they're bringing some of their own. What's a good amount to be able to say, hey, look, I can get started in this?
I mean, really any amount. When we started, when we were 27, we didn't have any funds of our own. And some of our lenders in the mastermind group don't either. And then some people come in with a bunch of money because they just, have been flipping properties for 20 years, for example, and they want to do a little bit less work. So they transition into lending. So it can be any amount. You don't necessarily have to have your own funds. It can be all investor capital. It is nice to be in a position where you can split deals with the investors you're raising capital from. Like if you can put 10% of every loan amount and have 90% be investor capital, like that's going to make your investors feel really good, right? Especially when it's early on and you're starting out. It's important to eat your own cooking, right? To invest in your own stuff.
For sure.
So to answer the question, any amount from zero to millions, it still works.
Fantastic. Well, Chris, how can people find out more about you if they want to invest with you, if they want to join the mastermind? Where do they go to find out?
Sure thing. Yeah. If you're interested in the lending business, check out hardmoneymastermind.com. And if you're interested in our lending company, maybe doing some kind of deal together in the Mid-Atlantic region, then check out hardmoneybankers.com.
Fantastic. Okay. And this has been great, Chris, and I really appreciate you being on the Wealth Flow. I've got two questions that I ask every guest. One is just, any advice you would give somebody who's maybe just starting out in their investment journey?
Just starting out in their investment journey. So I would go deep into education, and there's so much education out there. Back in the day, 20 plus years ago, you had to like buy courses and stuff like that.
Right.
Now it's all free on YouTube University, right? Like you can learn whatever you need, books, podcasts, everything else. I would go deep on education, but then also know that you need to pull the trigger and do a deal. Some people get stuck in that education mode for years and don't get out of it. At some point you have to pull the trigger and do a deal. That's the best advice I could give for somebody early in their investing career.
Yeah, I think that's great advice. How about a book recommendation? Doesn't have to be real estate related, but it certainly can be something that's been impactful that you've read.
There's a bunch of good answers to that one. I'm going to go with The Psychology of Money. Have you read that one?
I have, yeah.
It's fantastic. It's just a fantastic look at basically explaining why people do what they do from the lens of money. And people behave in all kinds of different ways. They approach their life in all kinds of different ways. A lot of it has to do with their background, how they were brought up, what they were taught, and just being aware. That was a big part of the book, is just making me aware of some of the decisions, some of the things that I think, my own psychology of money. And it's not a super easy thing to change, but being aware of it was really, really eye-opening. I think that would be a great recommendation for anyone watching or listening.
Yeah, for sure. It's a good, I forget the guy's last name. It's Morgan something.
Hauser,
yeah,
something like that. Morgan Housel.
Yeah,
fantastic book.
All right. Well, Chris, hey, appreciate it. This has really been good, and I think we'll call it a show.
All right, Keith. I appreciate it. Thanks for having me on. You got to do our pod sometime. You cool with that?
Yeah, for sure. Absolutely. Yeah.
Awesome. Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.